This is Andrew Jordan from NodeWise CPA. If you're preparing to talk to a lender or a buyer, you need to know whether your tax return and your financial statements match. And if they don't, why? Let me show you an example. All right, so this is the QuickBooks file for this demo client we set up. You can see here we've got their income, cost of goods sold, all the expenses, and we've got a profit of about $950,000. This is what most operators are used to looking at throughout the year. The first thing that's going to happen, though, when you give your financials and your tax return, because they always ask for both, to either a banker or potential buyer, is they're going to compare the two and they're going to see if they actually match. Because while the books are what you use on an ongoing basis, the tax return is what you actually sign and you send to the federal government saying these are my actual numbers. So they're going to want to make sure that those two match. So this is most common entity type we see for MSPs that are over $1 million is an S corporation. So 1120S here. And you can look at page 1. There's the income, matches the books. There's the cost of goods sold, that also matches. But if we go down a little bit, we see the profit. This is like half of the profit on your QuickBooks. What happened? That's the question you're going to get asked, and you want to be able to answer it well. So I'm going to walk you through 4 of the most common things that we see happen with MSPs that are these big differences between books and tax. There's other ones as well, but these are like the really, really common ones. First one, depreciation. A lot of times, depreciation doesn't get recorded, doesn't need to get recorded until you do the tax return. And often there's a strategic element here. You're deciding how much bonus depreciation, Section 179. Hopefully your CPA is doing that with you and deciding what's best in your case based on your tax situation, doing a little tax planning there. But because of that, like the books in our example don't show any depreciation this year. So that's going to be a big difference. Next difference, an easy way to see this, we'll go down a few pages. There's a section called M1, which actually tracks some of the differences between books and tax. And one of these is meals and entertainment. So the 7104 represents 50% of meals. Because for book purposes, you recorded the whole amount, which was $14,000. But for tax purposes, you only get to deduct 50% of that. So the other $7,000 gets added back for tax purposes. So it's another big and really common difference. For the next one, we're going to go back to the books real quick. And I want to show you Ask My Accountant. It's here on the P&L for the books. And it's $122,000. Well, that's not an account that usually you're going to see put on a tax return. And so instead, what often happens is the CPA will make a change. And it's not always a change that they're talking with you about. And in this case, in this example, I'm showing what often happens. That $122,000 got put down here in distributions. And a couple other things got our distributions as well in our example. But this number is inclusive of the $122,000, which means a couple things. One is you're not going to get any tax deduction for anything in that bucket. If some of it is actually legitimate business expenses, well, you want that counted because let's say all of it should have been deductible. You're going to be paying tens of thousands of dollars, probably more in tax because they just moved it to distribution. So that's like a freebie. Look at your tax return and see if any of these changes were made. It might cost you a lot of extra tax in addition to causing you banking issues or sales issues. The last thing I want to talk about, we're going to jump back to the financials one more time. We're going to look at the balance sheet. On the balance sheet, there's a negative loan payable amount. Now, you're not going to have in real world negative loan payable. That means you've overpaid a loan. So what happens is on the tax return, if we look at the balance sheet for the tax return, there's no negative loan payable. That got recategorized as interest expense to bring it back up to 0. And so you can see here on the tax return, there's interest expense. It's $23,000. That's not on your books anywhere. So that's a 4th difference that we see pretty commonly if you have any loans. Differences between your books and your tax return are normal. The important thing is understanding what they are and being able to explain them. When lenders or buyers review your financials, that's one of the first questions that they're going to ask.